Hi, welcome to MezFi Meets, Episode 2. This is Jerome, the CEO of MezFi. MezFi is a mezzanine finance investment company. Our funds are tokenized on the Ethereum blockchain. And today we're here with Jim Hardy, who is one of the 3 investment committee members for our fund. Welcome, Jim. It's good to have you here.
Thanks, Jerome. And thanks very much for the invitation to join the podcast today.
No worries at all, mate. Obviously, a lot of our listeners today will have tried very hard to get away from the traditional finance world, in blockchain, crypto, distributed ledger technology. A lot of people and a lot of the ideas are around the decentralization of the traditional finance world. But you have a really rich history in the financial services industry, and I think MezFi bridging both worlds. I think today we can deep dive into some of the traditional banking concepts, some of your history, and what you're going to bring to the table, and also why you're interested and excited about crypto, blockchain, and the future of finance as well.
Yeah, Jerome, you're right, and finance is a pretty dry subject. And I think that the world that we're going into is pretty interesting because the two worlds are coming together, the old world and the new world. If you think about, if I just touch a little bit on my background and history, and I came through the traditional banking sort of role in the late 70s into the 80s and the 90s, and saw the evolution and the decentralisation of money, and also the standardisation protocols that we used to live on in the past sort of changed, and deregulation in the banking industry in Australia. That created a whole spectrum of change in banking and finance. The thing that really makes me, excited is that if we adopt the principles of money as a form of exchange and the history of money and where that came from, those fundamentals haven't changed. Money is actually a memory of a transaction, and when you adopt that into our thinking now, that's very similar.
Yeah, no, well, very much, and I guess blockchain is just, at the end, at its core, it's a different way of accounting for those transactions. And Satoshi Nakamoto, in developing, obviously not by himself, with a rich history of other, cypherpunks, cryptographers, developing the backbone of this distributed ledger technology that we use in blockchain today. It is just the next step of the evolution and the taking out of the centralized hands of those recordings of transactions, and allowing us to no longer just have to transact with cash if we want to do it just between two parties without a bank involved. We can actually do it digitally as well without necessarily having to have the bank involved.
Yeah, you're spot on, Jerome. And if you think about way back in the day, bartering was before money. So what would happen is
absolutely.
Somebody would have 2 goats and they would trade it against 4, barleys of bushels of wheat. So you had that marketplace where transactions were happening in real time in the village.
Yeah, absolutely. What's your view then on, and this is going to be super controversial, I'm sure, but on Bitcoin as a means of exchange and a store of value for people to exchange with, and Bitcoin and other cryptocurrencies? How do they rate compared to, say, sugar back in the day, or gold or silver or cash? What do you think?
Well, it's a very good question. It comes down to the perception of the value that lies in there, and I guess once upon a time, and I keep on using historical analogies because I think at the end of the day we're just creatures of habit. So we're going to be repeating the successes of the past, but also the errors of the past. And gold and silver only came about because it was just shiny and it was something that people found it a little bit, nice. Why could it not have been emeralds or something? And we know that they sit in the stratum of value anyway, because that was historical over time. I think where we are now with crypto is pretty much when somebody in the marketplace went, well, look, I can't pay you 2 gates, but I want that bushel of wheat, so I'm going to give you a bit of gold. Oh, what's that? So that question would have been raised at that time. Oh, what's that? Oh,
Yeah,
it's
well, I
actually
mean, before,
something that's,
yeah, well, I mean, let's be honest, before, and obviously, Bitcoin is something that was created out of nothing, as opposed to, say, gold, which at a certain point in history, with our tools, we were able to figure out how to mine it. And it already existed. So this is slightly different from that, but it's more like cash. Let's be honest, which doesn't exist, isn't anything, and is only exists and is only valuable because we say it's valuable and we believe it's valuable. So it is, in that sense, the evolution of money, I guess.
it's a perception of value, isn't it? Right.
It is.
You're right. It's the perceived value of that, and that's where the value lies in that. It is a really interesting time as to how that's going to play out.
Yeah, well, a lot of people say, of Bitcoin that it has no inherent value, but then in the traditional world, but then people in the Bitcoin and decentralized world say the same of government printed money, because they're sick and tired of governments just printing endless amounts of money and saying that it has value, and so obviously there's two sides of that situation. But I think we spoke before about your history. You started in the 70s in banking. Why don't you? I mean, let's not gloat here, but why don't you just list some of the institutions that you've worked with? And I'm super interested to sort of get a vibe or a feeling about what the differences were between those institutions, which one you felt did the best, and what you think the state of banking is today compared to maybe back then.
Yep, no problem, Jerome. So really, when I left school, I wanted to earn money. I had got qualifications to be able to go to university. However, I could see that, and back in those days, and this is also controversial, actually, tertiary education was free.
Yeah, of course.
And that could be a whole other conversation that we could go into. In terms of an educated nation, there's an argument to say that. But anyway, we'll leave that topic alone for the time being.
Yeah, for sure.
So, but I wasn't going to be able to earn too much money, so I went into banking. It was either banking or public service. So I signed up and I joined what was then the National Australia Bank, and I was worked with them as at the bottom of the rung. I was doing I was a postage clerk. So that was just making sure that the money in the stamps matched up with what went out of the tin. Very basic stuff. But there was a structure in terms of a bit of career that went through there, and then you elevated through into debits and credits and understanding how that worked and how the cash worked. And then I left NAB after about 4 years and went to university to get a degree in business studies, majoring in economics, and then I did a minor in marketing. And that gave me a bit of an insight into the flow of money through the economy and the multiplier effect that it has. So that was good grounding. I went back to NAB, and for a couple of years I got married, and then I realised that there's banking, but then there was finance. And banking and finance is one, but there's also finance in the commercial world. So I got tapped on the shoulder to work for a finance company, and that's where I learnt the importance of understanding, I guess, street finance. I'm using that term colloquially, but it was about recognising what a deal is and being able to execute on that deal.
Was this a non-bank lender or
early 80s?
Early 80s.
Non-bank lender, Jerome. Yeah. Yeah, it was a non-bank lender.
Yeah.
Yeah,
so,
it was a broker.
I was a broker. Okay, very cool. Yeah. So there was a big distinction between those two, and And what did you enjoy more between working in banking and working in the non-bank lending space?
Well, the banking background gave me that sense of structure and being able to apply it into the non-banking world. So the broker actually had a principal and agency agreement, so we were able to lend on our own paper. But it meant that you knew that your brand was at risk. For all intents and purposes, the transaction was on-sold, if you like, and then we took the margin. However, because we were the primary brand, we were the one that would be wearing any of the downside. So that gave a sense of, how important it was to really be thorough. But I enjoyed that aspect of it because it was into that non-traditional fields where we're doing cash flow lending versus the secured lending that banking traditionally focuses on. Like, let's take a mortgage over something and then we'll lend it out. This was more about using the smarts of how you would assess, the five C's in credit.
Okay, and that's
I
that's
enjoyed that.
businesses. Yeah. No, I can see that. So that's I guess all of these kinds of things have stood you in good stead to be able to take a really broad view of the risks that are associated with deals, as we were discussing the other day, and as a part of MezFi and the investment committee, those are very much the skills that are going to have to come to bear. So why don't we talk about risk for a second? I mean, I think the risks involved with credit and finance, are probably not well understood. Obviously, banks they lend on that basis. So why don't we talk a bit with the five C's? I mean, maybe people don't know what the five C's of lending are. The five C's of risk.
Yeah. No, not a problem. Some people say 5, some say 4. I generally try to apply, the 4 core ones. So if we start with character, character is looking at the person or the entity that you're lending to, and this comes down to anything really. When we're doing any sort of transaction with somebody, we look at what does that person look like? Do you feel a level of integrity, honesty, all that sort of stuff. So then you've got conditions, and conditions are so much pretty much into the what environment are you lending into? If we think about what happened in the GFC, where we had the subprime market and we had organisations and throwing money into something where the conditions for that particular lending environment was just bad, right? So it's being able to look at that, I guess, that holistic view. And then you've got collateral, and collateral is what security are you going to take to make sure that that's going to come back? And that can be a range of things. That can be, real property. It can be, a registered charge over a business, and that can be a whole another topic if we get down that one. And then you've got capacity, and I think capacity is the most important part, because does the entity or the individual have the ability to pay it back? So they're pretty much, if you stick to the 4 of those, and I think that's fundamental in any risk mitigation or risk management, I should say, of a transaction. And in the capacity area, just touching on that bit, there's a range of different, and each one of those has a different level of analysis. You can go right down through, the assessment of the detail that sits behind it. So with capacity, you've got interest cover, you've got debt service cover, you've got financial ratios that sit in there so that you can look at the business, and it gets pretty interesting. And I'm just going to change my headset because it's just battery's running out. Give me a quick second.
No worries at all.
Am I back?
Yeah, you're back now.
Okay, terrific. Sorry, apologies for that interruption.
That's all right.
Once again, Jerome, like with collateral, what are the securities that you take that sit in there? Because all those agreements, when they come to, when they line up, it means that 1, you're going to be able to lend your money at a safe margin. 2, you're going to be able to lend it with a safe security buffer, and 3, you're lending it to the right person. All adds up to a successful transaction.
So speaking of collateral, I think in the case of MezFi being, mezzanine finance, which is subordinated lending, collateral is going to be key here for us to understand and manage that collateral risk because primarily the first mortgage is going to be taking 50% of the equity in terms of they'll only be lending up to 50% collateral and will be taking, the second tranche, so to speak, from there onwards. What, in your estimation, is a comfortable level to take second mortgage lending up to in terms of a maximum collateral position from your estimation?
It's going to vary depending on the nature of the lend. You would say somewhere if you look in an environment where the equity holder is going to be putting in 20%, you would maybe take the gap.
Yeah.
But at the same time, it's a little bit hard to say there's a fixed percentage that we would put in there. So you would look at the transaction and see what the level of risk tolerance would be for the equity holder. So I guess one, you would think that the senior debt or the first debt holder generally would be somewhere between 50 to 60 to even up to 70, which means that the MES could come into 10 to 15 because you really want, and I think it's important to have skin in the game here for the equity holder.
Totally agree.
So it would be somewhere in between that, and I guess the metrics on each debt or each lend would stand up to scrutiny as to, based on those metrics.
Yeah, that makes a lot of sense. So I guess that's why there's the 4C. So just saying. So you're saying that depending on the capacity and depending on the character, depending on those kinds of things, you can have discretion to say lend a bit more on a collateral perspective on certain deals than others. Is what you're saying?
Exactly. Yeah. And that's where it's quite fluid. You would assess it that way, and the way you would structure it, and obviously this would be based on the smart contracts that we would have in place. We would also have deeds of priority to the senior debt. So the senior lender would make sure that they've got coverage because they also include a little bit in there to make sure that if they have to call up their first mortgage, that there is maybe some provision for debt default interest provision in there. So we would actually then go in behind them and take our position with maybe a following GSD or general security deed, and that's a range of documents that our lawyers will be able to work out as part of the deal structuring.
Yeah, exactly. Well, I mean, right now, we'll be working with deal originators, wholesale mezzanine lenders, and co-investing with them. So we'll be able to leverage their due diligence documentation, and in the future, we may also be able to originate our own deals as well. And so, I mean, let's talk due diligence for a second. So, what are the kinds of documentation that we require in order to be able to do a good due diligence on a particular deal, and maybe importantly as well on a deal originator. So if we're co-investing with a mezzanine fund that's doing a large amount of deals, and we're co-investing with them, what are the kinds of things that we need to look at to make sure that we've got everything going well and it's a good deal?
I think it comes when you think about the 4 C's that I just mentioned. One of those that comes into it is I guess our level of comfortableness with the originator, because it's a partnership. Even though you've got one that's taking a bit of a lead here, there's a bit of codependency on each other. So having faith in the integrity of the originator and their assessment of the risk of the transaction is important. Secondly, I think that having access to the data that they have and the deal information on what that looks like, what it's trying to achieve, what is the length of time that the debt's going to be out, those sort of things are pretty key. From a documentation point of view, it would just be a structuring of the loan agreements that would sit, and having an understanding of what the loan agreements are with their borrower, and then having us written into the facility agreements so that everybody knows what's going to happen. Because in my experience, the absolute importance of getting the documentation right is critical. And when you're in lending and risk, you sort of have to look at it through the lens of what happens if this all goes south. Everything's fine until it's not. And I think it's the ability to make sure. But it also gives our investors comfort to know that we've got a level of due diligence and scrutiny to make sure that their investment isn't unduly at risk. There's always risk, but making sure that you're narrowing that down as much as possible, or tightening it up as much as possible.
Yeah, for sure. So last night we did an AMA, an Ask Me Anything Twitter space, and one of the people who was in the space was mentioning that the difference between crypto investment and, say, mezzanine finance investment is that crypto can be a bit of a casino. That people only think about the upside. They're thinking about the 10x, the 20x, the 30x. But with mezzanine finance and these kinds of products, it's, even though it is risky, as you mentioned, there is significantly less risk than just putting your money in a coin and hoping it goes up. And so, yeah, I guess it's interesting to me that mindset that we're going to have comparatively. I mean, it's more like DeFi. I'm not sure how familiar you are with decentralized finance and protocols and the way they work. So, what's interesting about that is that, they've taken finance principles, the old, collateral, and all of this sort of stuff, and put it into the crypto world where, people can have Bitcoin, they can have, assets, and they put them up as collateral, and they get a crypto loan for 60-70% of the value. And then if that the value of their asset goes down significantly, there's a margin call. If they don't get called, that it gets liquidated. So this is obviously a different kind of situation that we're offering, a different kind of product that we're offering. I guess my question to you, and you don't have to sugarcoat it. You can just say it how it is. What was it about MezFi and about the product that we're bringing to the table that was interesting for you, being a traditional finance guy, to get on board and be interested in being involved in what we're doing?
Yeah, that's a real good one, and I think that first conversation that we had when you asked me what do you like about this, is that I could see the look, I'm no expert in the crypto world by any stretch, but I've got a bit of an understanding at a high level about what it's looking for and what it's likely to achieve for people. What I think the MezFi part of it that made me very interested was the democratization of the investment capability into mezzanine finance. And I think the mezzanine finance isn't new, right? As a lending structure, it's not new at all. And I think that what you're doing here is getting the benefits of the Web3 environment with the ability to fractionalize ownership securely and safely, and then adopting that into the old world proven capability for subsequent dealing contracts in lending. You've got the best of those both worlds, and look, it'll evolve. I think that's going to be the thing that's going to make it a little bit different. the representation of the tokens, and people being able to say, well, there's my investment. I can see that there. That's it. It's almost like having a piece of the title on the wall, but it's your investment in the fund. If I'm reading this correctly.
Totally correct.
I think that's something that is a bit of a game changer, because it gives people the ability to be part of something that they were locked out of before. But we would be able to manage the risk on their behalf in a way that's transparent, but it's also in the new world. I think the future has got significantly a massive opportunity, in the sense that if, I don't know, I had this conversation with you that ultimate success for me would be in the property world, real world property to the digital world is, I go to an auction on a Saturday morning, I see a property that I want to buy, and by 3 o'clock I'm taking possession of the property, right? People would go, hang on, how can that work? And I just say, well, look, the reality is that the reason it's so long between me shaking hands with the guy that I've just successfully, bid on the property with, is because there's so many hands involved in the fulfillment chain. There's the agent's got to write up the contract. We all know how that works, and that takes, in Victoria, it can take up to 3 months. Because then you've got the lawyers, they've got to do the due diligence, they've got to do that. So if you can imagine where you've got distributed ledger technology that's able to, one, the bank can straight away know the data of what my spending patterns are, it could work out and assess me as a credit risk rated very fast. If you could just compress all of those aspects of what a fulfillment chain looks like, why wouldn't you?
Yeah, I totally
and I
agree
think that's where I get excited.
Yeah, well, we had this conversation, and I totally agree with you. I think this is the thing that I've been thinking about for a long time as being one of the best places to use the technology and the way that it secures and identifies ownership in a very secure manner and a provable way, because and look, last week I was talking with Mitch Travers from Solbiz, who's as a tokenization and soulbound token expert, and we were talking about digital identity, and it's a very similar kind of conversation where if you can have on-chain attestations from trusted bodies that provably show that I am this person, I have these characteristics, I am a wholesale investor, I am XYZ. You can easily also have, I own this property, this is my title on chain, this is the title, this is the this is the that. And if you have that technology underpinning all of this, you can very easily create that kind of an environment. And all it requires really is the trust in the system. Obviously, it requires a lot of investment in terms of time, in terms of development, in terms of money, to overhaul the system. And we also need to make sure that it's unhackable, because the last thing that we want is for these things to be hacked the way that a lot of these blockchain wallets are hacked. So the technology and the security needs to get absolutely top rate. And this is one thing that I've talked about with a few people, is that the only thing that we need to be careful about when it comes to blockchain is that in the finance world and in a lot of worlds, we have what's the word for it? Basically, we have a gap for a reason, a gap in time, and things don't happen instantaneously because we have checks and balances. And sometimes
Correct.
that human element is required to just sanity check the machines and our algorithms to make sure that we haven't gotten too smart for ourselves, because sometimes we have. And I know myself, when I automate things, I sometimes get things wrong, and everything went a bit too fast, and I'm like, oh, that happened. And So sometimes we do need those human checks and balances.
Yeah, 100%, Jerome. 100%. Look, the verification and validation process and that sense checking is critical. And I think we won't get to that, that scenario that I mentioned anytime soon. For obvious reasons, it's important to make sure that you've got that, that, oops, what happened there sort of thing, so that you can double check. 100%.
Yeah. And I mean, look, let's not even go to the AI where, people thinking that the AI are going to take over the world and all that stuff. So, these things are, I think they're probably beyond our abilities, or beyond mine anyway, to solve, especially at this juncture. Maybe through a number of more MezFi Meets conversations, Jim, we can solve all the world's problems. That would be good, I'm sure.
Yeah. No, we've got a long way to go. So I think in where we are with MezFi, I think we're if we get the basic principles, we've got the structure, and I think that adaptation of being able to invest in investable assets is we're in a good place.
Yeah, no, I'm very excited too, and hopefully things will move along at a clip. I mean, I had the meeting yesterday, the first meeting with the new responsible entity, and it looks Lee was in the meeting as well, and it seems that maybe a 5-week timeline may be realistic for launch, which would put us at the end of May. So if that's the case, then I'm very excited. There's a lot of work to do still, and then there's a lot of fundraising, and then there's a lot of due diligence. So got heaps of work in the future, and I'm very excited for it. So look, Jim, thanks so much for coming on today, mate. I really appreciate you taking the time to have the conversation. I think it'll be super exciting to do another one of these, maybe once we've gotten into the work of MezFi, once we've raised a bit, once we've gotten some deals under our belt, we can sort of meet up and shoot the breeze on some of the challenges that we've faced so far and some of the good deals that we've looked at. Obviously, not breaching confidentiality or anything, but we may be able to discuss some of the stuff that we've gotten into, and I'd love to have a further conversation in the future.
Yeah, no, it's a pleasure, Jerome. I'm really excited. I think we've got a pretty good product here. I think based on my read, it's going to be something that's going to be quite successful. I'm looking forward to playing a part in it, and looking forward to seeing how it when we get a few things on the table and absolutely get into proof of concept, because it is a brand new concept in terms of the democratization of it. So thoroughly looking forward to it, mate.
Perfect. All right, mate. Well, thanks so much for coming on today and taking the time to chat. Have a great day, and I will speak to you soon.
It's a pleasure. Thanks, Jerome. Have a good one.
Cheers, you too. Thanks for watching. If you want to find out more about MezFi, go to www.mezfi.com. Follow us on X, YouTube, LinkedIn, Instagram, and Facebook. You can see our shorts there, and look forward to the next conversation, and see you then.